The Federal Reserve is keeping interest rates unchanged for the third time in a row. The central bank also signaled interest rate cuts could be on the horizon in 2024. Chairman Jerome Powell said Wednesday there's still work to be done to bring down prices.
Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high. I want to assure the American people that we're fully committed to returning inflation to our 2% goal.
The stock market thought it was good news. The Dow soared more than 500 points, closing over 37,000 for the first time ever. Let's bring in Gregory Daco. He's the chief economist with EY, also known as Ernst and Young. Gregory, the market up 500 points. What are they concluding?
Well, I think the message is clear from the Fed. The Fed has pivoted. It was very candid in its acknowledgement that the economy is still robust but softening, and that inflation has eased much faster than initially anticipated, and that it is contemplating potentially easing monetary policy next year. I think that was the positive message that was taken from the Fed. The Fed is now in a better position to communicate its intent as to the speed of the easing of monetary policy next year.
So Powell said there are likely to be rate cuts next year. What does that mean he has determined about the economy?
Well, I think he's determined that we're making strong progress in terms of the rebalancing of the economy. We're in a better situation when it comes to the prior imbalances on the supply and demand side, whether it was the capital markets, whether it was the labor markets. That has allowed inflation to come down and therefore has reduced the need for as restrictive of a monetary policy stance as the Fed has had over the prior months. That will allow the Fed to recalibrate monetary policy to the downside gradually, but that is going to mean that 2024 is the first year where we see rate cuts in over 3 years.
And what does that mean when it's at home? Which is to say, if I'm a business and I'm now anticipating in the next year that there are going to be rate cuts, should we then expect economic activity where businesses start to take out loans to buy plant and equipment? How might this cycle through, those rate cuts cycle through the economy?
Well, I think we can't forget that we're currently in an environment of cost fatigue. The cost of everything is much higher than it was before the pandemic, whether it's goods, services, labor, inventories, you name it, things are much higher than they used to be. And then interest rates are also still very high. What this recalibration of monetary policy is going to mean going into next year is that both for businesses and consumers, it's going to provide a little bit of tailwind and prevent the risk of a hard landing. We see the recession odds as being slightly lower than 50%. And we think that this type of acknowledgement, candid acknowledgement that the economy can sustain this pace of growth at a lower rate of inflation is going to provide that necessary impetus to ensure a soft landing through the rest of 2024.
Well, that's my final quick question there, Gregory, has the so-called soft landing been achieved, which is to say interest rate hikes without crushing unemployment? Did the Fed pull it off?
That was the big question for 2023, and I think we've pulled it off. I think we've achieved an environment where inflation has come down within reach of the Fed's 2% inflation target without creating the recessionary headwinds that were once feared at the start of this year. The key question for 2024 is whether the runway is going to be long enough to sustain that. But the Fed's candid assessment of economic conditions and of the possibility of easing and recalibrating monetary policy next year increases the odds that we manage to live through that soft landing through the rest of next year.
Gregory Daco, chief economist with EY, thank you so much for being with us.